Partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, guys, welcome to the Limited Partner Podcast. This is another solo cast, so it's just going to be me talking this time. And just to kind of set the stage, this was recorded in early 2023. So there's been a lot going on. Since we started the show early 2022, the market has really kind of taken a different road. In today's episode, we're going to talk about what I'm really kind of concerned about for 2023, the things that I'm looking at, the questions that I'm asking. But before we get into that, I'll give a little bit of background, maybe some backup information on me and what's been going on. So holiday seasons were great. We were on the road a ton. So I live in South Carolina, I probably told you that, but my wife and I, we have family in Georgia, and we've been driving all over the place. We've 5-hour, 6-hour drives, you name it, all the time. And man, it was getting old. And we did that for a long time, especially when we were younger and kind of doing the property ladder thing. We were packing up kids for the holidays and hauling them everywhere with presents and you name it. But most of you probably didn't know this. In 2005, I got my pilot's license. I always wanted to fly. I thought that would be just a really cool experience, and it was. And we were flying a good bit. We were living in North Carolina at the time. We flew down to the Bahamas, to Florida, South Georgia. We did some really cool trips. And then as we continued to get older and started a family, all of a sudden there's a million reasons not to fly. It's too dangerous. I'm not flying enough, like airplane availability, insurance, it costs a lot, like you name it. I came up with every reason under the sun. And we were probably on one of our epic 6-7 hour trips back and forth between South Carolina and Georgia. My wife was like, it is time to start flying again. Like, we've got this opportunity. You've already been through all the hell in the world to get your pilot's license and your instrument rating, and you've done upset training. You've done all kinds of training. Let's do it. And she's like, as a matter of fact, 2023, one of my goals, so this is my wife speaking, is that she's going to get her license too. And it's something that she's always wanted to do. I just kind of beat her to the punch early on. And she's like, I'm going to do it. So like, this is going to be the year that we're going to start flying again. So we have been at it. She's already been through her written exam for her private pilot's license, scheduling lessons. So she's on track. I've been calling people looking for planes. I think what makes it really interesting for us, and part of one of the biggest excuses that we've made, is that we're a family of 6, and you can't just go rent a plane from your local airport that will haul around 6 people, much less 6 people with luggage. So it's a journey. So I'm excited to say that 2023, my personal hobby and kind of our family hobby now that my wife is getting into it, is we're going to fly. And just some really cool, interesting statistics is that you can fly from the United States all the way to South America from Florida, and then kind of start island hopping over the Bahamas and be within gliding distance of land 95% of the time. I just think that's cool. Like I said, we've flown to the Bahamas in the past, which is one of those things where I know we can do it. I know we can get there. So I'm just super excited to see what this year brings. And like, we're going to get out there. We're going to make it an adventure. So stay tuned. I'll try and keep you posted and updated as I do these solo casts on how that's progressing. But I've got some great tips. If you are getting into flying, or you're thinking about it, or you're trying to get back into it, I'd love to hear from you. So hit me up at the jake@thelimitedpartner.com and swap emails. I've got some cool tips and some cool things. We're actually doing some training here at home on the computer. So a lot of things that weren't available back when I took my private. But anyway, let's get into the show more proper. Like I said at the beginning, this market is changing so fast, and maybe a little bit more static than it has been in the past. But I mean, you talk about 2020, 2021, especially, I mean, things were going through the roof. Cap rates were compressing. I mean, we were seeing upper 2s, low 3s. Money was free, right? And people were out there buying. And I think that one of the things that's really interesting is that there was a period of time, it was really the longest period of time, about 12 years, but let's just call it a good decade, where if you got into real estate, you made money. And that's, for better or for worse, there's a lot of players in the market that have just been in a rising tide environment, and the tide's starting to go back out, and there's going to be some losses. There's going to be some losers out there, and I want you guys to be careful. right? I want you guys thinking about it like I'm thinking about it, is that I started my investing career back in 2008. If you remember, most of you may or may not remember this, but that was the big debt crisis the last time around. And I mean, the housing market went through the floor. I took the contrarian view, but there's that old saying, time is right when there's blood in the streets. And man, there's blood in the streets, and we were able to snap up some properties, but it was hard. It was very difficult. And there were times when me and my family, and maybe this is part of the reason we didn't fly, but we had to make some sacrifices to keep the old real estate empire, or just alive, much less growing through some of that. And it wasn't because we made bad investments, but like there's so much reliance on the debt markets and lenders and the government and like how they're doing things. And I mean, just a great example that we lived through is that when we started buying properties, you can have, call it an unlimited amount, but there was probably some number of government-backed mortgages, right? So Fannie Mae, Freddie Mac, they come back and buy the notes from the lenders. So the lenders would write you loans. And then 2009, forgetting the time frame because it came and hit us like a brick wall, 2009, 2010, they rewrote the rules and they said, hey, you can only do 4 per social security number. I think I had 6 at the time. And like, that was the business. Man, we were buying properties, renovating them, fixing them up, getting them reappraised, refinancing, moving on to the next, right? The old BRR strategy. And then all of a sudden, like the financing source just dried up. And I mean, it changed everything like overnight, right? Like yesterday I could get a loan, tomorrow it's like, sorry, you're full. Like you can't do this anymore. And those are scary, lean times. And the silver lining was that it forced me to go out and start raising private money, right? And before that, like I just didn't do that. Like we were able to kind of just build these assets one at a time, and keep going. But I had to start calling. I started doing webinars, right? Going out there and asking for money and raising money. And lo and behold, it worked. People were willing to put money in. We paid all our investors back, even through the worst years there. And everybody made money. And it proves that it's totally doable. And I think that I still have, I don't know, like war wounds from those days when all of a sudden this whole business model that I'd banked on just went away overnight because the government decided something and the lenders had to follow suit. And I think what's interesting is that we're in a similar period now, right? The debt markets are locked up, and it has a lot to do with you write a loan and the government's going to come over your shoulder and look at it and do a review. And a lot of banks, big banks, are basically saying, we're not doing it. They're telling their lenders at the desk, like, don't return calls right now. Like, it's better for us to sit on our hands than face the likelihood of penalties. And so I think we're seeing some of that now. But in this episode, I really want to dive into really 3 things. And that's the office market. And I think there's a lot that's going on with the office market that has trickle-down effects, potential trickle-down effects into the rest of real estate if you don't think about it isolated. The debt market, and then, like I said, how are those 2 things, the office and the debt market, really going to trickle over into other things like multifamily? And the reason I'm bringing that up, and this is foreshadowing what we're about to get into, but like you think about multifamily, self-storage, some of these other asset classes that have been really strong through the pandemic, rent growth, but at some point, the real estate market as a whole can start dragging down these performing assets. So we're going to get into that. But let's dive into the first one, office. Office is something that, like, even if you don't invest in office, I don't invest in office, it's something that you need to keep your eye on. And I'm actually keeping a very close eye. I read the news and I look for any article that mentions offices for a variety of reasons, because I'm really worried about a potential trend. So here's some trends. Like just this past month, probably a month and a half at this point, Blackstone and Starwood are starting to limit investor redemptions for their office portfolios, and really just their portfolios in general. A lot of it's kind of led by what they're seeing in the office market. And what that means is that typically investors in these REITs can kind of come and go on a quarterly basis, but there's only so much that's allowed to kind of be distributed per the rules of the agreement, and they're hitting those caps, right? So they're basically saying like, yeah, you thought you were going to come and pull this money out, but you can't. Better luck next quarter. Or they're putting some hard limitations on it because it's really affecting the overall portfolio. Public office landlords, they're starting to cut dividends and like lowering their expectations. I mean, that's not really a surprise, but let's talk about some numbers here. Office usage is about 40%, right? So 40% of capacity is kind of what you're seeing out on the office market. And that's according to PwC's 2023 Emerging Trends in Real Estate report. And that doesn't bode well. And I've had the fortunate, really it's a privilege, to sit in some offices of some of the largest office owners across the country and just kind of hear, what are y'all thinking about? And what they said was really the last quarter, right before Thanksgiving, is that they've come to grips with that as the new normal, right? The office world is kind of the new normal. There was a period of time where there was okay, we're coming back, it's surging, or people are not coming back, or like, what's it going to look like? And I think in the third, fourth quarter of last year, it stabilized. Right. And they're seeing that across the office portfolios, about 40% of the office space is being utilized, but that's off of badge swipes and people coming back to the office. That's a scary statistic for the office asset class. And the other thing that is kind of compounding on that is that office users are really focused on like A plus space. Why is that? You can get some of this other like A plus space, like some of the newer offices are actually leasing at higher rates than they did before, right? Like you would read these stories and think that the office is actually coming down, like lease rates, you could probably find some bargains. But what's happening is that the top of the heap is getting more and more competitive, right? Because everybody's trying to get into this top, the best of the best. And it's about hospitality, it's about amenities. It's like, what are you providing? And the rationale behind that is, one, companies are trying to figure out how to get their employees back into the office, right? So they know that they probably need the best space. They know they're going to have to re-envision the way they use the office. So therefore, like it's time to transition into new space. If we're going to make updates, maybe we're not taking out quite as much, but we're going to do something very different. They need the latest amenities. Health has become a really big thing, and it's really obvious now. And another interesting statistic that I want to bring into this conversation is that about 20% of office stock in the US is no longer fit for purpose. I think the number is actually a little bit higher than that, but there's a large portion of the office stock that was built before 1980. Let's call it more than 60%. 20% of the total office space out there is it's obsolete. And that is 1970s square brick, 8-foot ceiling, old ventilation, can't be retrofitted. Like it cannot be converted into office that people want to go to anymore, right? Like people are looking for higher ceilings. They're looking for health and wellness. They're looking for ventilation that's not potentially going to make them sick. And like, if you think about it, like you just don't want to go there, and it's hard to get people to come back. What's going to happen with that? This is kind of where we're getting into, is that like the office market, we're kind of working our way up to a cliff. And if you think about, more than 20% of the office stock will never, ever be able to be repurposed into an office going forward. I mean, that's 2 out of 10. That's not an insignificant number. And again, I think the number's higher. I'm being conservative here. And then you've got B and C class office space that maybe could be repurposed. But the problem is that you can't, if you're the owner of a B and C property that's going vacant, right? Like I said, class A plus might be 100% occupied or very close to it. If we're getting to an average of 40%, that means the B's and C's are really taking the brunt of that. And then you got some D's, which are these offices that nobody's going to go to anymore. But the issue is that, go back in time 3 years, that really wasn't the thing. Office was like the grade A paper. That's where the investments felt safest. There's always going to be a need for office. And they traded like that. Most real estate, as if you've been listening to the show, trades every 3, 5, 7 years. Like that's the life cycle. So in the last 5, 7 years, even these B's and C's have been trading at a price that like assumed into the future that they were going to be full. And it's not happening. The lease rates are going down and the vacancy is going up. And I mean, it's a death spiral. And I think what we haven't seen yet is we haven't seen this wave of offices coming back. I mean, as we think about conversions, I was in a conversation not too long ago of converting office space into residential. Sounds great, converting it into something else. But if you have to theoretically buy your office or buy this property that used to be an office at some rate that was built for an office of 3 years ago, there's no way you can make that make financial sense. And if you're the owner of that office, you're in the same boat. Like you can't then recap, something that's trading or you owe more money on, then it's way more money than it's worth. How are you going to go and do a massive gut renovation in converting an office? And I was in an office the other day and somebody had the quote of like, there's no amount of money. There's no opportunity right now in the space for any of our portfolio where we could do that. And I think that's where we're at, right? We've got this stock of offices that really hasn't hit the news yet of like what happens to that 20%. Like those are just going to go belly up. I mean, we've seen a couple articles out there where landlords have turned over the keys. I've seen 2 very prominent ones where owners of offices have just said it's not worth it. Bank, it's yours. And I think we're just at the beginning of that. And my worry is that as debt matures on these offices, that we're going to see a wave of it, and like 20-30% of the stock that's out there is going to be completely depressed. That's a lot. And I think that you don't really appreciate how much that is. But there was an article recently, I think on Biz Now, where they're thinking $40 billion worth of office space in New York alone is going to go belly up, right? That's going to be $40 billion worth of loss in value in just New York, the New York metro area. Like, it's impossible for that to not come into the market and have an impact on some other areas of real estate. So even if you're just like, hey, good for me, I've never been into office, I think you got to be watching these trends and just kind of see what's going on. So before I transition into the debt markets, I want to say one other thing about the office is that it's kind of a doom and gloom message. And I always like to talk about the opportunity. So there is opportunity. Like, skylines are going to change. If you think about 20% of the stock having to be repurposed or turned down, it's going to happen, right? Like, somebody can't just hold on to it because they want to. If they go belly up, they go belly up. It's still real estate. It's still scarce. There's an opportunity there, and people are looking at it. They're raising funds for these conversions, and they're effectively just waiting for the prices to be right. If we look on the bright side, and the thing that actually gets me excited is that this will be one of the largest changes in kind of the real estate environment and purpose of properties and the renovation or change of city skylines that most of us will live through. And I think that's coming. There's an opportunity to be a part of that solution if your eyes are open and you're ready, right? So I think people are getting ready for that and they're looking for it. So don't just assume that office is out there and it's a dead market. Be ready for it. And I think that's the opportunity. And I firmly believe that the vast majority of wealth is built in corrections and in downturns for those that are ready to play the game. So keep your eyes open, right? I think that's there. Okay, so moving on. Now we're going to move on to debt markets. So still a lot of uncertainty here. Like I mentioned earlier, the government is looking at loans and it's making banks say it's easier to not write them than to have to worry about the potential issues that come with it. The rates are unsettled. We're still not sure where the Fed's going to end. And I think there's a lot of pressure out there and people trying to say, hey, look, Fed, you're looking at you're behind a quarter on your data, right? So we are seeing and we're feeling the pinch now, but when you're getting your data and your reports, it's a quarter old. So you're seeing data from last quarter and maybe they're listening. And I think that the last rate increase went down. So it wasn't the 75 bips. We're down at 50, which is great. I think there's also some folks out there that think that they didn't go up fast enough and hard enough to really make a correction. But the short answer is that with the uncertainty and the not knowing when and how this is going to settle out, like, it's very difficult to finance deals right now. And some of the pressures that people are seeing in this marketplace right now is that, yes, maybe you can still get debt, but you're going to have to come up with more equity, right? So if you think about debt in the past, was it 3, 4, 5%? In the recent past, like maybe it's closing in on doubling some of those rates. That has a significant impact on the returns. But the other thing that's really important is that when you increase the amount of equity that's in the deal, investors are looking for returns north of 10. And maybe that's not as realistic, but like you got preferred returns, still seeing preferred returns 7-8%, our projected IRRs mid-teens. Like, that's still out there and that's still the expectation. And what that means is when you bring more equity into a deal, like, you're really putting a lot of pressure on that deal. So you've increased the rates on the debt, you're requiring more equity, which is requiring a larger return. If it was tough to cash flow a deal before, it's really tough now. So I think that the debt markets are settling down a little bit. I guess the last piece of that is if you can get it underwritten, even if you can make it pencil out, like I think the caps that they're putting, so the interest cap buy downs are so egregious that they're very expensive and very consuming from a cash perspective. So there's just a ton of pressure. And I think the risk, some of the syndicators out there, is that if you've looked at the business model, especially for companies that have been growing and growing rapidly and bringing on a lot of employees, the way the business is funded is through doing a deal, right? You get an acquisition fee, you do the deal, you cover your cost, and eventually you start selling properties down the road or refinancing them, and then you basically have a cash windfall that can kind of support your business. But if you got a business that's 5 years old or newer, there's a lot of pressure to do that next deal just to keep the lights on. And I would be cognizant of that is for you as a potential limited partner, passive investor in a deal, is just understand where the syndicators are getting the money to fund their business, right? Just kind of understand that. Ask the question. It's okay. right? Like there's only one chance you really get to ask your question. That's before you put your money in. Because once you put your money in, it's locked in. There may be ways to get it out, but I guarantee you that it's not going to be real favorable to you. Will probably be an easy way, a very nice way to put it. Meaning that if I'm the syndicator and I need to buy you out, or I'm a third party that's coming in because you need to cash out, right? Like, yes, we'll probably take advantage of that situation. Not saying that people are seemingly mean or out to get you, but like this is an opportunistic time. And those that have the cash kind of make the rules. So just beware. Make sure that you are comfortable where your cash is going before you lock it up for the next 5-7 years, especially with somebody that's relatively new, hasn't lived through a cycle, or just kind of growing their business and like they're expecting deal fees to keep the lights on. So just watch out for that. Now, here's an interesting story that I just wanted to share, because we're seeing some interesting things in multifamily. I had a really good friend here in Charleston that we were at a festival, let's call it a couple weeks ago, and he was so excited. He called me out across the festival and he ran over and he was like, hey, like we got to talk about these apartments. Like we are seeing some massive price valuation drops already. And I was like, well, like, what are you talking about? Like, nobody's really talking about stuff happening in multifamily. And he said to me that they have seen deals that they appraised in April that fell through have come down 20 to 30% just this year, right? So a deal that was up on the market, that was appraising at, let's call it $10 million, is now appraising somewhere in the $7 to $8 million range. And that seems drastic, and that's not across the board. And people will probably call me out for that, but it's happening and he's seen it. And he was like, man, if you were looking to buy, like the time is right now. Like get your ducks in a row because like this stuff is happening. So like these deals haven't closed, so it's not really hitting the streets yet, but it was just really interesting to see. Like I might have a friend of mine who we've talked real estate for a long time, just gets so excited and say like, man, this market is insane. If you have the ability to go get some of these deals, like get your checkbook out because now is the time. But all right, we're going to kind of close this out and we're going to talk about the trickle down. And I think I've been alluding to this throughout the recording here, but apartments, self-storage, other asset classes that are really just not office have been doing very well. And it's a real interesting time because rent demand is still up. Developers are actually slowing their roll a little bit because they don't want to be caught with inventory. Like everything else, like one, the cost of everything has gone up, debt costs have gone up, and those are the things that will sink a developer. So a lot of developers are kind of saying, well, we're going to finish out the projects that we've got, but we are not getting super aggressive on building anything else. And what that does is that means that like in a market that has seen 25% rent growth on an annualized basis over the last year, the market is not going to satisfy the demand that keeps coming in. Now, again, the economy might, and those are the things that we've got to worry about. But if you're in a high population growth or you're looking at investments in a high population growth, we're not on track to build our way out of this right now. And as a matter of fact, like there's a lot of concern that like we're shooting ourselves in the foot with the way that the government is handling this, because there is a housing shortage and prices are going to continue to go up. Now, what makes that interesting is that when you think about the market, you may have deals or in distress simply because the debt, the bridge loan, the 3-year, 5-year, whatever bridge loan is now due. And when the deal was underwritten, the rates were at 3-4%. And now maybe they're 6-7%. And then the buy down caps on the interest rate to keep them from going through could be several $1 million. And it could put a deal that's throwing off cash left and right in distress because it just can't be done at the new rates. But what's even more interesting is that this cliff that I was talking about at the office, I think that if and when we start seeing more and more an acceleration of like these 20% of the office properties that are effectively no longer ever going to be capable of being offices again, the vacancy rate is 100%, meaning that there's nobody in them. Nobody wants to be in it. The keys are just going to get handed over. Like when those start hitting the market, what is that going to do for the rest of real estate? Like I said, I get to sit in some really interesting conversations in the real estate industry. We had an executive raise his hand in one of our conversations, and he said, what are other people thinking about the possibility of office like dragging us down? We're a multifamily shop, but like we're really worried about that. And I think it's a real concern. And that's why, like I said, I'm not interested in office right now, or I haven't been interested in office. I'm actually getting more interested in office because I think there's going to be an opportunity, but I can't ignore it because I think that is the elephant in the room in terms of commercial real estate right now. So I think the trickle down effect and the possibility of it creating a kind of of a perfect storm of all of these things kind of happening at once. We've got Fed raising rates, we've got employment ticking down, we've got deals that are not closing. Then we have the office that could completely spontaneously implode. What is that going to happen to lenders and folks that are pricing assets in other asset classes? I don't know. So keep your eye open for that. Like, I'm not all doom and gloom. I do think there's going to be some opportunity, but it could be kind of blippy here for a little bit. But if you see an opportunity, don't just assume the worst. Like I said earlier, the vast majority of wealth is built in a downturn. So being ready to buy and being able to move quickly is where the deals are at. And then I think really the last kind of point I want to make too is that opportunistic deals, especially right now, are going to be quiet. There is still folks that they have some pride. They don't want their information out there. Like they've got some properties that are in distress of really no fault of their own. It's just the economic situation and kind of the timing and maybe some decisions that were made a couple years ago on debt structures or what have you. But those properties are going to need to get moved on, and they want to do it quietly behind the scenes. So, what's starting to happen behind the scenes is the brokers and folks are calling folks. They're saying, hey, we got a deal and it's an opportunity and it's real quiet. And the one that can get their checkbook out the fastest and kind of make things happen is the one that's going to win. So I think that as you're looking at sponsors, this is where having a great sponsor relationship is going to pay off. Is that, like, do they have that relationship, and do they have a plan, or do they have the ability to do a deal right now? And if they do, then they may see some opportunities that haven't been seen in decades at this point. Even with the great market that we've seen over the past decade, the opportunity to pick some stuff up quietly behind the scenes and be able to move fast, that's where it's at. I think that's where it's going to be. So I think overall, I want to leave you with this, is that real estate is going to bounce back. Like, as a whole, real estate's going to bounce back. The debt issues are completely manufactured. So we printed free money for a long time. Never done that before, or at least for that extent. And we're paying the price now. But we manufactured it. The underlying economics, like the properties are not in distress. And this is not a 2008 where there's actually like a ton of bad loans and folks that should never have gotten loans and properties that were never going to cash flow, never going to pay themselves back. Like, we're not in that situation now. So it's going to come back. Now, with that said, office is never going to be what it was. That's just a fact. But there's a ton of opportunity if you want to get into something new and your eyes are open. Be ready, be thoughtful, and have an open mind. I think that over the next 5 years is probably going to be one of the more exciting times to be in real estate, because there's going to be a ton of transformation. Businesses are looking at real estate in a different light than they ever have before. That's owners, and those are the occupiers too. I just think that's exciting. And I am really eager to see what comes. And I am looking and I'm scanning the news and I'm talking to people every day. I'm still thankful that we started this podcast, because it gives me the opportunity and really the onus to get out there and do it. And there's a lot of pressure to keep having these conversations and learn. There are some real sparks out there, some real excitement. Yes, I think the overarching theme is a little bit pessimistic, but behind the scenes, there are people like me that are looking at this and like, wow, like the market's going to look different. Office is going to look different. Housing is going to look different. And I want to be a part of that. We transform this skyline. We transform the way we work and live. It's like the guy that started investing in cell towers or leases back in the day, like transform the way we communicate. I want to be a part of that. And I think that's exciting. So I'm looking forward to what's next, and I hope you are too. 2023 is going to be an interesting year. And I think that if you are smart and you're open to having conversations and you listen and you're willing to move, right? Like, I don't want you to be paralyzed. I want you to be willing to make a move when you find something that's a good opportunity. And I can't tell you, but to a certain degree, you'll kind of know in your gut, but ask some questions and be ready to move. And like, you have to go into it with that mindset. You have to. Like, if you just think like, I'm going to wait and see, you're going to wait and it's going to pass you. But you got to be smart. Like, it's been easy for the last decade. You put your money to work in real estate and like, you got to ride the train up. Now, smart people are going to make the money, and a lot of money is going to be made, and a lot of wealth is going to be accrued by people that are willing to move. So go do it. So I'd love to hear from you. If you have questions, you have thoughts, you disagree with what I said, whatever, reach out. Jake at The Limited Partner. Let's have a conversation. Let's keep this conversation going. If you have ideas or thoughts or questions about further shows, I'd love to hear from you too. But anyway, this has been a great conversation. It's been good coming back. I'm really excited about 2023. I've got to do it with your eyes open. It's going to be fun. This is Jake Wiley, your host of The Limited Partner. We'll see you next time. I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.